Welcome to another tutorial video. This time around, we're going to be discussing enterprise value and why you add and subtract certain items when calculating it. Now, like a lot of other tutorials in this channel, this one is actually an update of an earlier tutorial that we published. I felt the previous version didn't do a great job of laying out the rules and explanations for different line items. Also, some accounting changes since that time mean that some updates are required to those rules. The most common question we get here goes something like this. I understand the mechanics of the enterprise value calculation, but not the why behind it. Can you explain why you add and subtract certain items to calculate it? As usual, I'm going to give you a short answer here in a few minutes, and then we're going to go into a more detailed and lengthier explanation. We will be referring to the filings of this US-based company, Steel Dynamics, and then this European company, Vivendi. So Steel Dynamics follows US GAAP, Vivendi follows IFRS. So you'll see how the accounting rules differ a little bit in these calculations. We'll also go through an Excel file where I've laid out the equity value and enterprise value calculations and the valuation multiples for both these companies. The short answer here is that enterprise value represents the company's core business, so it's net operating assets to all the investors in the company. And equity value represents everything the company has, its net assets, but only to the common shareholders in the company. Normally, we start this calculation for public companies with equity value. We calculate it by taking the share price and multiplying by shares outstanding. And you can see an example here for Steel Dynamics. It's just the share price times the diluted shares. And for Vivendi, it's the same idea. The share price times the diluted shares outstanding. So that's almost always the starting point for public companies. Then to move to enterprise value, we add liability and equity line items that represent additional investor groups, because equity value is just the common shareholders. Enterprise value is all the investors. So if something represents another investor group beyond the common shareholders on the liabilities and equity side, we need to add it. And then we subtract assets on the balance sheet when they represent non-core or non-operating assets, because enterprise value is about the company's core business operations. Equity value is about all the company's assets, their net assets technically, but we only subtract things when they're on the asset side. So if something is non-core and is not required to operate the company's business, then we subtract it in this calculation. So typical subtractions here are items like cash, financial investments, equity investments, also known as associate companies or joint ventures, net assets held for disposal, and net operating losses. What all these have in common is that they're all non-core. Yes, all companies need a certain minimum amount of cash, but beyond that, the excess is not required to run the day-to-day business. If a company sells software or operates retail stores, it doesn't need to invest in stocks or bonds to do that, so financial investments are non-core. If it owns a minority stake in another company, that company can't possibly be that important to the parent company, so equity investments also count as non-core. If the company is about to dispose of certain assets, they're obviously not that important because they're disposing of them, so they're also non-core. Net operating losses are a nice bonus that reduce taxes in the future, but they're not truly required to ship and deliver products and services to customers. In terms of typical additions, the most common items are debt, preferred stock, non-controlling interests, unfunded pensions, and sometimes leases, which gets a bit complicated. We'll save that until the end of this tutorial. What these all have in common is that they all represent additional investor groups. With debt and preferred stock, it's pretty easy. The company needs additional capital, so it borrows money from lenders or it raises preferred stock, and then it pays interest on the debt or pays preferred stock dividends to the preferred stockholders. Non-controlling interests are typically added back for comparability reasons, but they are also added back because you could view these as another investor group. When the parent owns a majority stake in another company, technically it has some power over those minority shareholders as well. So in that way, you could sort of view this as another investor group. Unfunded pensions, here, what's happening is that the employees are effectively acting as an investor group because they are accepting less money today in exchange for pension benefits later on when they retire. And if the pension is unfunded, in other words, the liabilities exceed the assets, the company is effectively borrowing to meet that need in the future. Leases get complicated, but the short answer here is that if you consider them another investor group or a form of capital, that's fine, but you have to be really careful with the valuation multiples and how you calculate them. The basic categories here are always, never, yes, but it's complicated, and maybe. And so we're going to go through each of these sequentially, start with the always items, which are fairly simple, then go into the never items, which are also fairly simple. The complicated items are a little bit more in-depth and take a bit more time to explain. And then the maybe items, lease liabilities, restructuring and legal liabilities, and deferred tax liabilities. Some people will argue for always including these. Some people will argue for including some. Some people will say that you should include none of these. So we'll go into this and break it down and explain our views on what to do. With the always items, generally what you want to do is go to the company's most recent balance sheet and get all the numbers from there for the cash, the debt, the preferred stock, and so on. And if you have extra time, you can certainly go a bit beyond this and you can search for fair value or fair market value in the filings to get the market value of items like debt and preferred stock, where the market value might be a bit different from what's on the balance sheet. So with Steel Dynamics, for example, let's just go to their 10Q. They have cash and equivalents, and so we went and then we just subtracted this number in our Excel file, cash and cash equivalents right here in the first line under equity value. So that's pretty simple. They don't really have anything for financial investments, equity investments, or other non-core assets. They do have some net operating losses, but we'll return to that later on. And then going down, they don't really have anything else here that should be subtracted on the asset side. On the liabilities and equity side, they have current maturities of long-term debt. They have long-term debt. They have redeemable non-controlling interests, and then they have normal non-controlling interests. The non-controlling interests I just took directly from the balance sheet and put them in here. There's no estimate for the fair market value of these, so I just entered them as is. With the debt, this number is slightly different from the one given on the company's balance sheet. With this one, I went back to the annual filing and they disclosed the fair value of the debt there, the fixed rate and the variable rate debt. So I just entered these two numbers. It changed very little between the annual report and the interim report. So I just took these and assumed that market value here was probably closer to reality than the book value shown on the balance sheet. So that's what we did for Steel Dynamics. Now for Vivendi, let's go over and take a look at their balance sheet. They have some items we know that should be subtracted: investments in equity affiliates, non-current financial assets, current financial assets, cash and cash equivalents. And so in the Excel file for Vivendi, we subtracted cash and cash equivalents, financial investments, and equity investments. They don't have anything for net operating losses or other non-core assets. So far, all of this is pretty standard and straightforward, and nothing else here qualifies to be subtracted. Now on the other side, they have non-controlling interests, they have long-term debt, long-term leases, and then they have short-term debt and short-term leases. So these are all traditionally items that may be added or that sometimes may be added in the case of leases. And sure enough, we went in and added the debt, we added the non-controlling interests, and operating lease liabilities. Will address this later on because we're adding these for Vivendi, but not for Steel Dynamics. Unfunded pensions we'll also get to later on. With the debt, my number here is slightly different from the one on the balance sheet for the same reason. I just went into the filings and found the market value, which was different by maybe 1 or 2 percentage points for this company, but not a big deal if you don't have time to do this. Let's now talk about the never items and the general approach and the main categories. First off, working capital items like accounts receivable, accounts payable, inventory, deferred revenue, deferred costs, etc. are all operational in nature. If you think about it, it wouldn't really make any sense if we said that, for example, for a steel company, that we should subtract their inventory because it's non-core. They obviously need this inventory to manufacture steel, so it makes absolutely no sense, and you never want to add or subtract these line items. Long-term assets like net PP&E, goodwill, other intangible assets, these are all considered operational, so you do not want to subtract these. Again, obviously a steel company needs factories to produce steel, so you can't just say that these are non-operational. Intangible assets and goodwill arise from previous acquisitions. If they still hold those acquired companies' assets, therefore, then these should also be considered operational and core to the business. Then you have items like accruals of income taxes, interest, and so on. And at first, you might look at something like accrued interest and say that it is non-operating or financial in nature. And in a sense, it is, but the problem here is that this doesn't really represent long-term investment in the company or an outside investor group in any way. All it represents is the fact that the company may accrue interest over a month or 2 months or 3 months and then pay it in cash at the end of the period. So it's really just a simple timing difference, and it doesn't tell you anything about the actual outside investor groups. These are represented here by the debt investors mostly. Category number 4, lease assets. The assets here are always operational regardless of the lease type. The question is what to do with the liabilities. And frankly, they're so small for Steel Dynamics that the company doesn't even list lease assets separately. Vivendi does list these separately. They have right of use relating to leases here, but these are always considered operational and core to the business. If the company does not lease buildings or equipment, it cannot produce media content and then monetize that content. So it has to be part of the company's core business. And then finally, industry-specific items like content assets for companies like Netflix and Vivendi. You can see an example here. They have current content assets. This is clearly operational as well because this is how Vivendi makes money. They create these content assets, music, TV shows, anything else that they can broadcast or stream or make money from. It's a core part of their business, and so it makes no sense to subtract something like this. Let's now go into the complicated or more complicated items. And the two main examples here are net operating losses and unfunded pensions. With net operating losses, you want to subtract these if they're shown within the deferred tax asset, but you may also have to adjust them a little bit. If there's a valuation allowance, meaning that the company doesn't expect to realize the full value of the NOLs, then you may factor that in. And if the NOL number you find is not shown within the deferred tax asset, so it's off balance sheet, then you'll want to multiply by the tax rate to get the actual tax savings that the company is going to realize from that. Vivendi doesn't have any net operating losses, but Steel Dynamics does. And they have some information about it in their 10K. I'm just going to expand the comments here so we can scroll down and find the part where I've highlighted this. Okay, so here it is on page 68 of the 10K. They have the net operating loss carryforwards of 25 million. They have a very small valuation allowance. This is such a small deduction that I've just ignored it in the calculation here. Technically, we could factor this in, but I don't really think it matters. We're not multiplying by the tax rate here because these are shown within the deferred tax asset, which means they should have already been multiplied. In other words, off balance sheet, this company probably has more like 100 million in net operating loss carryforwards, but on balance sheet, that's the number we want, and it's already been tax affected. So we can just use the 25 million there and we don't have to do anything else. The next item that gets a bit more complicated is the unfunded pension. If a company's pension liabilities exceed its pension assets for a defined benefit plan where the employees get set payouts based on their years of work experience and age in the future, then unfunded pensions effectively represent another investor group. Effectively, the employees are funding the company today because they're giving up some pay in exchange for greater pay or some amount of benefits in the future when they retire. So you want to add the unfunded amount, but you may have to adjust it first because of how the tax laws around contributions into defined benefit pension plans work. What I mean specifically is that if pensions into the plan are tax deductible in the company's country, then you multiply the unfunded pension by 1 minus the tax rate, because when the company contributes to its pension plan, it will save something on taxes by doing so because the contribution is tax deductible. So if it's tax deductible, you take the max between 0 and the pension liabilities minus the pension assets and multiply by 1 minus the tax rate. If it is not tax deductible, you take the max between 0 and the pension liabilities minus the pension assets, but you leave out that 1 minus the tax rate part. In metrics like EBITDA, you also have to be careful to deduct only the service costs associated with the pension. You don't want to deduct the financing and other costs because you're adding the unfunded pension, and these financing and other costs correspond to this unfunded pension. With Vivendi, in their annual report, they disclose under note 19.2.3 on page 92 that their position here is negative 792 million euros for their pension. So their pension assets over here on the right side, the fair value of plan assets is 639 million, liabilities is 1.431 billion. And so in Vivendi's enterprise value calculation, I've added the unfunded pension here. With many European plans, contributions are not tax deductible, so I've not multiplied this by 1 minus the tax rate, but we could take some time to verify this. We're not sure exactly how it works in France or if that's the case in all the countries where Vivendi operates, but that is our quick approximation for now. Let's now turn our attention to the last category here, the maybe items, and start with leases. Normally, you add finance leases, also known as capital leases, because under both major accounting systems, US GAAP and IFRS, the lease expense here is split into interest and depreciation. So what that means is that metrics that pair with enterprise value, like EBITDA, completely exclude or add back this lease expense already. If you're using EBIT, then you'll need to make a small adjustment and you'll have to deduct the interest element of this finance lease. But metrics like EBITDA are fine because they already add back the full lease expense for finance leases. With operating leases, it's easier to add these to enterprise value under IFRS and then not add them under US GAAP. Under US GAAP, operating leases just have a simple rental expense that's already deducted in EBIT, EBITDA, and so on. And so you'd have to add it back if you wanted to add the operating lease liability in enterprise value. For example, for Steel Dynamics, the company has around $21 million in rental expense on its income statement. It has an operating lease liability of around $90 million. And so if we want to include this operating lease liability and pair it with a valuation multiple like EBITDA, that's fine, but we can't just use EBITDA. We actually have to add back the rental expense on the income statement and use EBITDAR instead of EBITDA. Now, if we're just using EBITDA, this already deducts the lease expense or the rental expense. And so we can use enterprise value excluding operating leases here and pair it with EBITDA. And you can see how in each case, we get to about the same result, 7.2x. Under IFRS, we don't do that because operating leases are already split into depreciation and amortization. Therefore, when we add back the D&A and the cash flow statement to get to a metric like EBITDA, this already excludes the full operating lease expense and the full finance lease expense. And so you can see how all the metrics down here are based on enterprise value, including operating leases. And you can also see how under IFRS, EBITDA and EBITDAR are actually the same. So this is one difference, and this explains why we're adding operating lease liabilities here, but we're not adding them for Steel Dynamics. Of course, I would emphasize that regardless of how you treat this, the multiples will generally come out to be about the same anyway. So it's not going to make that big a difference. It's more a matter of personal preference here and consistency. The next item here is restructuring and legal liabilities. We usually say, no, you shouldn't add this because these do not really represent a separate investor group. The counter argument here is that some people will say these liabilities could result in a large cash outflow in the future, so you should add these in the calculation. The problem is that you could apply the same logic to almost any liability the company has. So what is really different with this? For example, would you add an earnout that the company has as a liability just because it may be paid out in the future to an acquired company? Also, the other issue here is that even if there is a large cash outflow, it often shows up only on the cash flow statement. So how are you going to adjust or deduct it or add it back in income statement based metrics like EBITDA? There is a case perhaps for adding these back in some situations, but we generally don't recommend it unless it's extremely high and the company is expected to have to raise debt or some other financing source to pay for this in the near future, for example. Another item here on the maybe list is the deferred tax liability. A lot of people will argue that these represent another future cash outflow. It might be large and therefore it should be added to the company's enterprise value, increasing the enterprise value as a result. The problem is, again, you could apply this to standard operational liabilities as well. For example, what if the company has a large accounts payable balance? Should you count that in enterprise value? And the answer is no, because it's operational in nature. The timing of cash payments for deferred taxes is uncertain, and the company won't necessarily raise capital to make these payments. So we think the case here is pretty weak. Also, deferred tax liabilities are not interest-bearing, just like restructuring and legal liabilities are not interest-bearing. So it is pretty difficult to put these in the same category as debt and preferred stock in most cases. That's it for this tutorial. To do a quick recap and summary, when adding items to calculate enterprise value, starting with equity value, you have the always category, which includes things like cash, debt, and preferred stock and non-controlling interests. If you can, get the market value for debt and preferred stock at least. If not, it's usually not a big deal. Then you have the never items. So you're never going to add or subtract working capital line items or industry-specific items like content assets for Netflix, long-term operational assets like PP&E and goodwill, for example. Then you have complicated items like net operating losses and unfunded pensions, which will usually factor in, but you may have to adjust these a little bit and take into account the company's tax treatment. And then you have the maybe items like lease liabilities, restructuring legal liabilities, and deferred tax liabilities. And in all these cases, they either depend on the accounting system, as with lease liabilities, or they're very subjective and not something that we recommend adding or factoring in at all in the case of the latter two. Some people will argue this very aggressively that you should, but in our experience, most banks and other finance firms don't do this, and we think the case overall is pretty weak in most scenarios. That's it for this lesson. Hopefully now you know a little bit more about how to calculate enterprise value and how to quickly look at a company's statements and decide what should go in it, and also what to do if you have a bit more time and you want to get more exact estimates for some of the numbers.